And welcome to our webinar today, December 15th, 2010. The topic for today's webinar is the Year-End Tax Update 2010. I want to remind everyone that questions are welcome, and you can submit your questions by simply typing them into the box on the screen and sending them. We will attempt to answer all of them during the webinar. However, if we run out of time, we will certainly get back to any of you with questions that are outstanding. We will again be offering CPE credit for the program, and as such, we will be giving CPE codes 3 times during today's presentation. If you'd like to receive the CPE certificate, take note of these codes and return the completed CPE form to Jen Cadju in our office. Our guest today is Beth Grubb. Beth is a tax partner at Battelle Battelle and has been with the firm since 1995. She is a 1980 graduate of Penn State University and a 1983 graduate with a master's in business administration from the New Mexico Highlands University. She obtained her accredited business valuation designation from the AICPA in February of 2000, her CVA, Certified Valuation Analyst, from the National Association of Certified Valuation Analysts in February of 2001. She is a member of the American Institute of CPAs and the Ohio Society of CPAs and the Financial Planning Association. Well, that's a lot of stuff, Beth. Welcome.
Thanks, Jack. Thank you for facilitating this, and thanks to all of our listeners. We welcome you and hope that you will get a lot of good information on what has developed this year that affects your tax liability, and knowing that many of you are coming from diverse backgrounds and have your own individual situations, we have a ton of material here. This will be a very fast-paced presentation, cover a lot of ground, but we trust you'll get some benefit from.
Beth, there's been a lot of stuff in the headlines today, and I think they're actually taking a vote as we speak. So have at it. I know you got a lot of stuff to cover. So
yes, I will spend the beginning of this presentation covering the tax legislation and the developments, including the House or the Senate vote today. 2/3 of this presentation will cover the vote today and what that package looks like. We'll talk about the best way to do your tax planning and business-specific strategies. That'll be about 2/3 of the presentation, and the remainder covers individual issues that affect our investors and those who have estate planning needs. But let's jump right into this exciting vote today. Recently, President Obama put together a tax package, and it's the vote is in the Senate today. We expect the Senate to pass it, and then the deal moves to the House, where we do expect that the bulk of the legislation will pass, although Democrats have voiced specific opposition to the tax cuts for the wealthy and some of the state tax changes. But let's cover the key components of what is being voted on in the Senate here as we speak. First and foremost, we have the individual and investment tax rates. This package proposes to extend the current tax rates for all income groups, and our chart that follows is giving our listeners an idea of what the 2010 tax rates look like, with the top rate at 35%. If these rates were not extended, rates for our wealthier taxpayers would rise up to 39.6%. We don't see this happening, but keep this chart in mind for future years because over time these rates could creep up. They're at all-time historical lows. But this extension for the lower 2010 tax rates also includes extending the low tax rates on capital gains and the qualified dividends. So if approved, the extension will keep in place the 15% capital gains and qualified dividend rates. There are also some tax credits, the college tax credit, child credit, and the earned income credits that will be extended. Democrats, some have opposed the estate tax provisions in this bill, and this is actually a new development in this package where it includes an increase to the individual estate exemption up to $5 million with a low 35% tax rate on a taxable estate. So this is very generous in light of where we've been and what was being proposed. In exchange for some of these tax cuts, unemployment insurance benefits should continue for another 13 months. We should also expect, we should also expect the AMT patch where the package would amend the alternative minimum tax indexes so that approximately 20 million taxpayers who should not get hit with it wouldn't. In addition, we expect even more generous benefits for capital-intensive companies. And this particular legislation, as soon as we know what develops here, we will send out a tax alert to let you know about the provisions for capital expenditure write-offs. In addition, there's a new payroll tax cut in this particular legislation where workers would get a 2% cut in their share of Social Security tax. So what that means is on the employees, their share of Social Security tax would only be 4.2%. Finally, there's some expiring provisions like the research and development tax credit. We want to watch that would be extended. Many of our clients benefit from that particular credit. So we want you all to watch your communication from us, the Battelle tax alert, and other forms of communication. We will let you know exactly what this legislation looks like when it passes, and we expect it to pass in the next few weeks. Now, in addition to what we want to watch, many in our audience are responsible for the accounting and some of the tax reporting for their companies. And so I do leave a reminder here for you all to watch the developments on the Form 1099 and W-2 reporting. There are some new laws in place. One kicks in 2011 for those owners of rental properties. So check the information that we send you or call us on those new rules. And in addition, there are some 2012 rules for businesses that are very, very burdensome. And we actually hope for some change in those rules. So watch our alerts there. Today we'll cover the Healthcare Reform Act, the HIRE Act, and the Small Business Jobs Act. These are three key pieces of legislation enacted this year, and we'll focus on the areas of those acts that will affect many of you. So knowing that healthcare reform, which is the piece we'll start with, this has been enacted to increase coverage for Americans as a trade-off for increased coverage. There are going to be some restrictions and mandates on insurance companies, higher taxes and fees to the healthcare sector. Some of us are experiencing already the higher premiums on health coverage, but what we'll focus on in the next couple slides is the additional reporting and administration, as well as more specifically the enhanced healthcare benefits for smaller companies and the increased Medicare taxes on high-income individuals. So let's look at an example of how our smaller companies can benefit from healthcare reform. In 2010, we have a new tax credit for purchasing group health coverage, and this credit is available for employers with 10 or fewer full-time equivalents, and it's in the case that those employees earn an average of less than $25,000 a year. Now, there's partial credits for companies that have fewer than 25 employees, those earning less than $50,000. But what the credit looks like, it's a maximum credit of 35% of the premiums paid by the employer, and the employer must contribute 50% of the premium. So any of you out there with this size of a workforce covering employees, please contact us. We'll get the information on your tax return to claim this very valuable credit. Moving on to some of the costs associated with healthcare reform. I've presented this in the form of an example, but before we get into the example, specifically what we have starting in 2010 is an extra 0.9% Medicare tax on wages over $250,000 for a couple, over $200,000 for a single taxpayer. So it's that extra 0.9% Medicare tax. And then we have a new 3.8% Medicare tax on unearned income. So in this example, where we have a couple and their combined wages are $500,000 and they have $100,000 of net investment income, what we have is an additional $2,250 tax. That's that tax hike on the wages above $250,000. And then they have this new 3.8% tax on their unearned income. So what we've added in 2013 to our higher income taxpayers, in this case, is an additional $6,000 of tax. Unearned income for this tax includes interest, dividends, capital gains, rental income, and passive activity income. So in 2013, as we're preparing and planning for this new tax, keep in mind that really beefing up your retirement contributions will help you lower and avoid this new tax, because retirement distributions are not unearned income for this particular tax. So it's another reason to max out on your retirement contributions. Let's look now at the HIRE Act. The HIRE Act is another piece of legislation enacted to promote hiring. And in this legislation, we have two pieces. We have the payroll tax forgiveness and the retention credit. We have the 6.2% Social Security tax on new hires. It's totally forgiven for 2010. In addition, if you keep those new hires 52 weeks, you have a $1,000 retention credit. So the rules here, the new hires must generally have been unemployed 60 days prior to their start and hired before January 1st, after February 3rd of 2010 and before 1/1/11. Keep in mind, students qualify for the Hire Act benefits. Oops, sorry. The Small Business Jobs Act. This is very business friendly in that it has a lot of accelerated depreciation rules that will help many of our listeners. For S corporations, this act has reduced the built-in gain recognition period to 5 years, starting in 2011. We have a new one-time tax deduction for health insurance on self-employed individuals. We have some more options for credit for small business. We have an increased business startup expense threshold. And very significant to many of us is the new Section 179 provision. It allows us to write off up to $500,000 of qualified investments, and the code Section 179 deduction starts to phase out after an investment of $2 million. We also have 50% bonus depreciation on all eligible property. We have some relaxation of the rules on cell phones. And unfortunately, we have a new 1099 reporting rule starting after December 31st, 2010 for those engaged in rental business. So please contact us if you think you're eligible for any of these particular benefits. I'm having a heck of a time. Let's shift gears a little bit. We've covered the three big tax acts, and I just want to shift gears to get us more into the planning mode to help you all be more effective in developing your tax savings plan.
Okay. Hey, Beth, before we get into that, there were a couple questions on the first section. One is the question on the employer part of the tax. Is there a similar 2% reduction? No. There is not. The other, so it's only the employee part that is being reduced?
Yeah.
Okay. The second question, and I'm not sure we have an answer for this yet, but how does this have an impact on retiree benefits under Social Security law? You know, if we don't
have a crystal ball for that. Great question.
Okay.
Maybe one of our listeners has the answer. I don't.
Yeah. You know, as we move into the tax planning basis, the basics. This is a time when it's really important for the client to be in concert with the service provider. So if they have changes in their business, that's what it's important to convey that to their tax professional, because they can then match up the changes in rules with what's the changes in somebody's business.
Yes,
correct?
And I think we've all experienced the opposite situation where those changes or the plans weren't communicated as timely, and you look back 2020 and say, geez, had we communicated these plans and developments sooner, we could have taken advantage of more. But what we really look to do is to focus on two key areas. One is tax law change, and the other is your business or personal change. And here at Battelle, what we try to do when tax laws are changing, we try to communicate those to you all as rapidly as possible to keep you in the loop and help you identify what in the law changes you can take advantage of. And then when it comes to business change, we try to stay in touch with you, but we certainly welcome any opportunities to hear about your plans so that we can match all of the rules and developments to your particular situation. And specifically here, what we want to do in planning is now that we know where we are in terms of what the Senate's voting on, the 3 laws that were enacted this year, we also want to look out ahead in terms of what areas could we really expect more tax law changes, and advise you as these changes are developing. But we do expect more changes affecting high-income individuals. We do expect potentially tax increases on foreign income, and then the additional compliance and burden associated. That's just going to be a lot of back and forth until some of those requirements are hashed out. But we do continue to expect favorable changes for our smaller businesses. Then on the flip side, what do we look for in helping you all minimize your tax as your business changes? And we really focus on people, property, technology, and more than ever, these green projects. And specifically with people, we have the opportunity at the federal level to take the work opportunity tax credit, which is geared towards hiring certain sectors of our population, including our veterans. We also have state and local hiring incentives, tax incentives, and training incentives. On the property side of things, we already talked about the increased ability to write off capital expenditures. So as you're expanding or adding equipment, please contact us so we can get the best tax savings plan in place. On the technology side of things, as you're adding research and development activity or developing a computer system, there are tax credits out there at the federal, state, and local side for those activities. And then what's really taken hold and will come more into all of our tax planning schemes is how can we maximize tax savings through the green project investments that we make. Investments in lighting, investments in energy efficient equipment, and we've had some great experience in that particular area. I think Jack is very familiar with some of these particular projects and has seen that we've been able to practically pay for the cost of these projects through sweet loan packages as well as state and local tax incentives.
There's a lot of changes that are coming about at the state level, but certainly on the federal level with the investment tax credit, it certainly is significant. Beth, I want to get the CPE codes in, and I did forget the first one, so I'll give you two codes right now. The first code is 35, and the second code is 33. So those are the first two codes, and we'll give the third code at the end of the session. So we're caught up on the housekeeping.
Good deal. So we've covered at a very high level how you all can benefit from change, either from how the tax law changes can help you, how you can plan to avoid extra tax from tax law change, and then also how we can work with you as you're hiring, adding to your facility, engaging in research and development and green projects. So from a very high level, now let's look at what we try to help you all with at this time of the year. And really at this time of the year, as we come to the end of the year, we work with many of you as business owners or responsible for the business or your personal tax liability, and we try to help you properly time income and expense to reduce your tax liability. We work with business projections to really maximize any opportunities we have to lower your tax bill. And with the tax extension package here, with continued low income tax rates, we maintain our basic recommendation that you should defer income into future years. But in an unusually low income year, the rule changes where maybe you want to accelerate income and defer deductions. Remember that in accelerating deductions, as we move into higher inflation in the future, consider something like the LIFO inventory method for those who carry a lot of inventory. So which items can we control when we're looking at deferring income and accelerating expense? Well, we won't cover this entire list in detail, but these are some of the things that you all can control in terms of deferring income, such as bonus income or deferred compensation. You can defer real estate transactions, but watch for things like rising tax rates where you may want to stop the deferral. On the Roth IRA conversion, this is a year where we can take a very unique benefit by converting IRAs or 401k plans into Roths, and we can do this because the income level has been lifted. In doing this conversion, we can then make the payment of the excess tax in 2011 and 2012. So for those who have a long time horizon for their IRAs, consider that Roth IRA conversion. Finally, on the distribution of earnings and profit by S-Corps, this works very well for those who have been C-Corps and elected S status. Contact us if you think you could benefit from this, but I think this particular technique will be out there in the next couple years. Moving on from what we can control to now some very specific business tax saving strategies. We've covered the pending legislation, we've covered today's vote, we've covered the best way to address change in tax planning. Now let's look at what we can specifically do, and of course we can't cover everything in this section, but I'll focus on a couple key tax saving strategies. In the top of this slide, we've already covered in the Small Business Jobs Act the generous Section 179 expensing level and the bonus depreciation. We also expect that these generous benefits will continue or even be expanded into 2011 and 2012. But keep in mind that our states, Ohio and some of the other states that you all operate in, do not accept the generous federal depreciation deductions. So we do want to make you aware that your state tax liability may not be reduced as significantly as your federal liability for depreciation deductions. Now, what else can we do? We have these generous depreciation deductions available to us now, but what more can we do? And one thing we can implement is the cost segregation. And what we do here is identify components within a building. This is specific to those who have recently invested in plant expansion or commercial real estate or have made significant leasehold improvements to their facilities. What we do, our goal here is to increase our depreciation deductions by separating out components such as decorative fixtures, security equipment, parking lot, landscape, certain wiring and pipes that are connected to equipment. And so this is a way to get more bang for your buck when it comes to depreciation deductions. Let's look at just a simple example of cost segregation. For this particular taxpayer who invested in a $2 million building, without any thought, without a cost segregation study, that building would be depreciated over 39 years, straight line. What a cost segregation study does is identifies and separates out 15-year property, such as the parking, the landscaping, or 5 to 7-year property, such as a structure that is connected to equipment. So in this case, what we've done here is illustrate that there is a cost savings by increased cash flow earlier in the project's life because of these accelerated depreciation deductions. So this is just a reminder as the economy gets going again and investment picks up, those who are planning to make plant expansion, significant leasehold improvements, please contact us to see if you can benefit from a cost segregation study.
Beth, do cost seg studies apply to new property only, or can you do new or used?
Definitely new. And with used property, cost segregation study works. It is sometimes more difficult to get back into some of the older records that describe the project itself, but we can do those as well. So it's new as well as those who have property who may think they could benefit, need a little cash flow boost. What else can we do? We can also, in addition to dealing with depreciation, which is more of a timing benefit, we can also implement strategies that give us permanent tax reduction. And I've named 3 here because they represent 3 different types. The IC disc is really a reduction strategy that takes income and separates it out so that it can be taxed at a lower rate. That's tax arbitrage, and that works very well for companies with foreign sales from the U.S. We have quite a bit of success using the IC disc. The domestic production deduction, this has been in our law for several years, but this year we finally get up to the 9% deduction. And this particular benefit it's a freebie. It is a deduction that we take on the tax return, but your company does not have to write a check for it. So it is limited in terms of its use. It's available to manufacturers and businesses, but remember, it's available also to construction companies, engineers, computer software, and agricultural processing. So that's another permanent tax deduction for many of you out there. We also have tax credits, and they reduce your liability dollar for dollar. The R&D credit is for qualified research. We do expect that to be extended through the current President Obama's package. We have an alternative fuel credit. We have been very successful with this particular tax credit. So if in your business you are using propane or other alternative fuels, please contact us. It is another freebie that's just money back in your pocket. And I've already touched on the work opportunity credit. Here's a little more information about that federal tax credit. So remember that not only do we have some of these strategies and accelerated depreciation options, but we also have ways to permanently reduce our tax through what we call tax rate arbitrage using the IC DISC, a permanent tax deduction, the domestic production deduction, and certain tax credits. So we're going to jump quickly into, okay, what are we doing here for investors and individuals? And in framing this particular planning, you always want to keep in mind what type of assets you own, your income, and the holding period ahead. So I think we've settled on where capital gains rates will be. 15% is what we expect. We thought they were going to go to at least 20%. And this 39.6%, I think it's out the window for now, but we will keep an eye on those. This chart here is really to kind of frame our discussion in terms of what investors want to consider when they're looking at their portfolios and different types of investment income. So your best option is really your tax-exempt or non-taxable distributions that have no tax associated with them at the federal level. We have the capital gains rate of 15% on long-term capital gains and qualified dividends. We have a special 25% tax rate on certain gains from real estate sales, and then our ordinary income, such as interest, is subject to a tax rate of up to 35%. And as you're working with your investment advisors, they really want to find out from you, you know, the tax costs so that they can help you structure your portfolios. One particular rate that we expect will be extended is this 0% tax rate for lower income taxpayers. Just keep in mind that while this is a very unique and beneficial tax rate for capital gains, if you have someone under the age of 24 who has appreciated assets, capital gains assets, they may not qualify for this 0% tax rate. But it's just something to be sure to inquire with us if you think you have an opportunity to structure transaction and qualify for the 0% rate. Capital losses, many of you, your investment advisors, are probably trying to figure out if now's the time to take advantage of those losses. Contact us if you're not sure what your capital loss carryforwards are. Those carryforwards are very valuable to you when you have capital gains. Investments and structuring investments. I really want to leave this particular section with just a recommendation that you look at your investment portfolios, use the charts and the information that I've given you to help structure your entire portfolio. Your investments that should potentially remain outside of your retirement accounts should include the tax-exempt bonds and the capital gain property, whereas investments that have a higher tax cost, like taxable bonds, interest-bearing accounts, and REITs, should potentially be in your IRAs or your retirement plan. So just keep that rule of thumb in mind as you're structuring and making reallocations in your portfolio. Consider that capital assets are at historic lows, interest rates also at historic lows, and the time to act is really now in terms of taking advantage of the low dividend and capital gains rates. Home ownership. What has happened here in recent months? Well, over the past year and a half, we have the new home buyers credit. We have the $8,000 credit for first-time home buyers and the $6,500 credit for those who have owned their home for a while and qualify for it. Look at your closing statement and contracts and contact us. It requires that we attach some of the documentation from your closing to the tax return to take advantage of this credit. Some long-standing deductions from home ownership include the property tax deduction. Pay any real estate tax bills now, but watch out, the rules always change when the alternative minimum tax is involved. Keep in mind your mortgage interest deduction limits. With all the refinancing that has been going on, if you've crept up over these mortgage limits, your mortgage interest deductions will also be limited. And certainly try to get your energy efficient purchases in place because there are very valuable credits, up to $1,500 of credits for qualifying purchases. So be sure to let us know so that we can claim that credit for you. As far as selling a home, again, with many of us having our home as our biggest asset and tax shelter, keep in mind that there is your principal residence exclusion where you don't have to pay tax on your home's gain. But if any of you are like me where I'm not buying up in terms of a home, I'm just investing so that I can stay in my home, and in doing so making some improvements to the home, I have to keep thorough records of those expenditures because they increase the basis and reduce the gain when we do finally go to sell. Remember, you can't deduct a loss on a principal residence, and if you do have a second home with a gain, you may be able to reduce tax further by converting it to a rental. And then what else? What else can we do with property? Well, you know, to really get a bang for your buck, the installment sale is a key technique to continue tax deferral. And then the Section 1031 or the tax deferred exchange on real estate also allows you to continue to defer gain on your real estate sales. Okay, finally, as we wind down this particular presentation, we want to touch on estate and gift tax planning. Not only are there more generous provisions in the bill that's being voted on today, but there's also a lot of things that you can do just every year to transfer your legacy either through charitable giving or to your loved ones. And so we want to touch on the planning related to estates and gifts. Let's look today at where we are. The middle column, 2010, shows us that our federal estate tax rate and GST rate was 0. Our lifetime exclusions and GST exclusions also 0. Basically no federal tax on estates for those who passed away in 2010. However, we have carryover basis rules, and we have some more complications, still being proposed in legislation. On the far right, if we didn't have new legislation or extender legislation, we'd be into these higher rates in 2011, up to 55% tax rate on taxable federal estates, and much lower lifetime exclusions. But where we think we're going to be with this extender legislation is we think that we're going to be at a 35% estate tax rate on federal estates that exceed $5 million. So again, watch for your Battelle tax alerts, and we will let you know what the final rules are. Let's look at some popular techniques as far as giving or reducing an estate. We can give our money to charity. We can institute an annual gifting program that can be either to charity or individuals. We can transfer private company interests or investments through family limited partnerships. We have the grantor retained annuity trust, and we have many, many other techniques, but these are the ones that we routinely work with our clients on, and today we'll just cover quickly charitable giving and the grantor retained annuity trust. Specifically with the grantor retained annuity trust, because there's been a lot of legislation over the past several years trying to extend the term and reduce the benefits on these. So we just want this in as a reminder for those who need to efficiently transfer their wealth. But starting with charitable giving, remember, in recent years we have stricter laws on gifting to charity and the substantiation. So keep these rules in mind. And also remember that if you have publicly traded stock that you've held more than a year, you can get a double dip in terms of a benefit here where don't sell the stock. Transfer it directly to charity or to a charitable foundation. You will not only avoid the tax on the capital gain, but you can also deduct the fair market value. So that is a very easy and very beneficial technique. Donate public company stock. For those who need to transfer a lot, consider these three key techniques: a private foundation, a donor-advised fund, or a charitable trust. The private foundation is more complex, but you have more control over how your donations will be used. The donor-advised fund, that has less complexity and much easier to get in place before now and the end of the year. The donor-advised fund, for any of you who have an unusually high income year, it may be a way to really knock that tax liability down by getting a big charitable contribution into a donor-advised fund before the end of the year, or you could set up a charitable remainder trust. We don't have enough time today to go through the specifics of these techniques. This is here to remind you if you need to do something quick between now and the end of the year. The grantor retained annuity trust. I want to mention this technique because it is still a technique that those with very high estates or those with large business interests, it's a way that you all can move a lot of wealth to those you want to receive. And so it's an efficient way to lower the gift tax on gift transfers. But specific to where we are today in 2010 with low interest rates, the grant is more valuable than ever. And the way this thing works is, as long as the current interest rate in the economy is lower than what you expect the rate of appreciation to be. So if I expect my assets to appreciate by 5%, but the IRS interest rate is only 1.8%, which is what it is today, the GRAT is a fantastic way to transfer wealth, because what you do is transfer those assets that you put into the GRAT today, and they will appreciate at that higher rate. Remember, short-term GRATs, such as the 2-year GRAT, may be short-lived, given what we've seen in recent tax proposals, but it's here for now. So just keep that in mind. And this is how it works, where the donor puts in, let's say, something like S-Corp stock, which works really well. The S-Corp stock goes into the trust. We not only leverage the interest rates to get a lower gift, but we also leverage valuation discounts to lower that gift even more as it goes into the trust. The trust pays out an annuity through the S-Corp distributions, and at the end of the term, the beneficiaries get the stock. So it's just a fabulous way to remind business owners of this opportunity to transfer wealth. So this really gets us to the end of our presentation. We have covered a ton. I feel like I haven't taken a breath, you know, trying to get you all of this information, and we encourage you to watch the tax legislation and watch the Battelle tax alerts, any other correspondence that you get from us. Call us if you have some year-end moves that you want to talk over with us to reduce tax. Remember the 3 key laws that we covered and how they can benefit you, and please just call us, call us, call us.
Beth, we had one more question come through, and it went back to an earlier section on the new 3.8% tax on unearned income. Does this tax apply to Roth IRAs, or are they included with the non-retirement accounts?
It would not be on, it would not, 3.8% would not be imposed on Roth IRA distributions.
Okay.
Yes.
And I thought you'd covered, but I wasn't sure if we had specifically
No,
said
I
Roth.
appreciate the clarification.
Okay.
Yeah. Good. Well, with that, that wraps up our tax update for this year. We really appreciate everyone who attended and look forward to working with each of you. Wish you the happiest holidays and a very fruitful and blessed new year.
Well, Beth, you took my wrap up there. I do have one more CPE code, and that last code is 28. And again, certainly thank everybody for attending today. Our next session will be January the 11th. Our presenter will be Chris Finney, and the subject will be property tax abatement. And again, wish everybody happy holidays, and thanks for listening in.